Hello, Assalamu alaikum students. This is your teacher Azka, and today we are going to start this paper. This is basically AS levels paper 1, made into Feb March 2024. So as you can see, this is the paper in front of you. It's the latest paper, and we are going to solve it. So let's go. Okay. So give me 1 second. Let it just suddenly disappear. I don't know why. So let's check it out. Yes. So this is back now. Okay, so we have the question number 31st. So which statement about the CVP, it means the cost profit volume analysis is are correct. Okay. So just remember that what is the CVP analysis and how that was used to construct. So first option is that fixed cost remain constant for a range of activity. So yes, this is right. If you just remember the cost volume profit analysis, so yes, fixed cost is remaining whether the range of activity is increasing or decreasing. Number two is profits are calculated on an absorption costing basis. So no, it's not like that. Like this is not calculating on the absorption costing basis. Sales revenue increases in direct proportion to output. And this is also right. And there is only one product or there is a constant sale matrix. So yes, there is only one product in the CVP analysis. So it means that 1, 3, and 4 is right. So C option is right. So let's check out the other one. So company has following budgeted information per unit. So we have the selling price which is 75 dollar and variable cost is $10. Fixed cost is $72,000. So what is the increase in break-even sales? Okay, so first of all, let's focus on this question that they are talking about the sales, not about the break-even units. So it means that first of all we have to find out the break-even units, and after that we will be multiplying a number of units with the selling price. So we will be having our answer. So we have to find increase in break-even sales if fixed cost has increased by 33. It means that this is somehow 33.33%. Okay. So it means that first of all we have to find out the old break-even sales, and after that we will be finding out the latest break-even sales. Okay. So formula is same. Break-even units is equal to fixed cost over contribution. So fixed cost over contribution. So contributions formula was selling price minus variable cost. So selling price was 25 and variable cost was $10. So it means that contribution would be $15 and fixed cost is 72,000. So we have 4,800 number of break-even units. So multiply it with the 25. So we have the break-even sales which is $120,000. So now let's see the new break-even. So if you multiply 72,000 with the 33.33%, so you will be getting 24,000 fixed cost. So just add into it because we have to find out that if the fixed cost increase by 33.33%, so at that point, what will be our break-even sales? And we basically are trying to find out the increase number of sales, increase amount of sales. So 72,000 plus 24,000 is 96,000 fixed cost divided by contribution, which was 15. So it is same, it is not changing. So we have the break-even units, which is $6,400. So multiplied with the selling price, which is 25. So we have the break-even sales, which is $160,000. So but we have to find out the difference between the old break-even sales and the new break-even sales. So 160,000 minus 120,000. So we have the $40,000 break-even sales, which is basically difference between the uh, old break-even and the new break-even because of the increased fixed cost. Okay, so now let's see the other one. So which changes result in decrease in the margin of safety? Okay, Okay, so in question number 28, that which changes result in decrease in the margin of safety? Okay, um, so basically, margin of safety is, we know that this is the difference between actual or expected sales and the break-even sales. Okay, so it indicates that how much sales can drop before the company reaches its break-even point. So first of all, to understand these changes, that how changes would affect this margin of safety. So first of all, we have to consider the variable cost. So we know that that if unit variable cost increases, okay, if variable cost increases, so it means that cost to produce each unit is higher, and which decreases the contribution margin per unit, and this would leads to a higher break-even point. And if we talk about the total fixed cost, so we know that if total fixed cost increases, so company needs to cover more fixed cost before making a profit, which also increase the break-even point. So it means that both increases in unit variable cost and total fixed cost result in a higher break-even point, which decreases the margin of safety, and that's why it means that option D is the right option. Okay. So now let's see this question. So X Limited has budgeted overheads, which is 125,000. Just give me one second. Okay. So X Limited has budgeted monthly overhead, which is 125,000. So this is budgeted monthly overheads. Its overhead option rate is $5 per machine hour. So in July, there was an under absorption of overheads of $1,000. So basically, we have the answer of under absorption overhead, but we don't know that what is the actual overhead absorbed. So what changes from budgeted data causes this to happen. So basically, we have to consider all these 4 points, that if our overheads has increased by $500 and machine hours less, if this is less by 100 hours, so is it our answer would be equal to $1,000 of under absorption overheads or not? If this is right, so it means that option A is right. And you have to check all the options, and after that you will be knowing that okay, which option is basically the right option. So first of all, we have to find the machine hours. Okay, so how can we find it out? The actual machine hours. So we know that we have the formula of OAR. So it means that if we want to find out the budget machine hours with that, so we can easily do that. So OAR is $5. Okay, and budget overheads was $125,000, and budget machine hour would be 25,000 machine hours. This would be our budget machine hours. Okay, so um, if you will take the example, if you just use this option A, that if our actual overheads was increased with 500, and if actual machine hour is less than maybe decrease with the 100 hours, so will it be equal to $1,000? Like will be able to get the under absorption rate of overheads, which is equal to $1,000? So let's check it out. So we know that how can we find out the actual overheads? So our budget overheads was 125,000, 5,000 higher. So it means that our budgeted overheads was $125,000. So if we just add this $5,000 into it, so it means that our actual overhead would be 125,500. And if we want to find out our actual machine hours, so we know that our budget machine hours was $25,000, which we just find it here. Okay. So actual machine hours equal to 25,000, and in the option A, it was less by 100. So if you just decrease it with the 100, so we will be having our actual machine hour, which is 24,900. So now we are going to find out the overhead absorbed, because we don't know that what is the answer of the overhead absorbed. So your actual machine hours multiplied with the overhead absorption rate, which is $5. So it means that our overhead absorbed is equal to 124,500. Okay, so this is basically our actual overheads. Okay, and that was sorry, this is our overhead absorbed, and this is our actual overheads, 125,500. So it means that this is giving us the answer, which is $1,000. under absorbed. So it means that our option A can be right. So, but if you want to check out the other option, so you can easily just follow this formula and you can say the method. So you will get to know that your all answers are wrong and your option A is the right option. Simply, you can also say that because if you see that in the option B and option D, it is showing us a 500 lower overheads and 750 lower. So it cannot be happen because we already we this statement is showing us that this is the under absorption of overheads $1,000. So it cannot be lower overheads. So it means that B and D option is not right. So your right option is can be A or can be C, but I just worked on both methods, so our option A is the right option, but I'm not applying all the formulas and all the process on the C part. So if you want to just check out, so you can just use all the process for the C part, but yes, the right option is the A. Okay, so the next question is that the following information is forecast the next month. So we have the opening inventory, closing inventory, marginal cost profit, and the absorption cost profit. So we have to find out the overhead absorption rate per unit. So for finding out the overhead absorption rate per unit, first of all, we have to know that what is the production level and how much the overheads. So if you want to find out the production level, so we can easily find it out by deducting the closing inventory from deducting the opening inventory from the closing. So it means that 2200 is 2200 units is basically a production level. And we know that the marginal cost profit and the absorption cost profit is same other than the overheads, because we know that in the marginal cost profit there is no overhead included, but in the absorption cost there is included the fixed overheads. So it means that if we deduct absorption cost profit from the marginal cost profit, so we will be having our overheads. So 1,04,000 minus 90,600. So we have the overhead, which is 29,800. So just divide what was the number of units. So number of units was 2200. 9,800 divided by 200. So we have the $4.45, which is our overhead absorption rate per unit. Okay, so now let's discuss the 75 MCQ. What is an advantage of absorption costing? So we know that absorption costing, the first advantage of the absorption costing is that it helps to determine the product selling price. Okay. So let's see the B. It is used to improve the operational efficiency. So just remember that absorption costing is just a quantitative information. It is not related with the any qualitative thing. So that's why by using the absorption costing, we cannot improve our operational efficiency. So B is not the right option. It makes it easy to analyze cost at different production levels. No, this is very complicated to know about the cost at different production level. So that's why this is not appropriate for the advantage of absorption costing. D is saying that it takes into account only variable cost. This is also wrong. We know that this is also catering the overheads. So it means that A option is the most probably the right option. Okay. So direct material cost of batch of soft drinks is 10,000. Uh, just give me 1 second. Okay. So direct material cost of a batch of soft drink is 10,000 for 50,000 cans, and 60 direct labor hours are required at a cost of $40 per labor hour. Okay. So overheads are absorbed at 10 to 50% of the cost of direct labor. So what is the cost per drink per soft drink can to be the nearest all dollar? Okay, so this is very easy. First of all, we have to find out the direct material cost. So our direct material cost is 10,000, as we know. Okay, and our direct labor cost would be 40. Basically, we are using the 60 direct labor hours and we are paying $40 per labor hour. So 40 multiplied by 60 is equal to $2,400. Okay. And overheads. So basically overheads is just 250% of your direct labor. So if you just multiply it, it means that it is 2.5 times of 2,400. So 250 multiply $2,400. So this is basically giving us the amount which is 6,000. So altogether our total cost would be 18,500, 10,000 plus 2,400 plus 60,000. So our total cost would be 18,400. So just divide this 18,400 with the number of cans, which is 50,000. So this would be giving us the answer, which is 0.36, or you can say approximately 0.37. So option B is the right option. Okay. So now let's see the other one. So in the other question, that which statement describe just-in-time management of inventory. First of all, it increases administration cost as more suppliers are required. So this is not because in if you are using the GIT, so you are not required many supplier. You can implement the GIT by using the services of only one supplier. So a option one is not the right option. Second one, that it is a management strategy that minimizes inventory to increase efficiency. So yes, this can be right. Producers hold only sufficient inventory to meet maximum market demand. So we know that the GIT, we are not maintaining a very high amount of inventory. So yes, the second, third option is also right. In fourth, the system benefits cash flow and reduces the amount of capital required to run the business. Yes, if you are maintaining the GIT, so it means that you don't have to put a lot of money into inventory. You don't need to purchase a very high amount of inventory, or that's why it means that your cash will be less tied up in the high level of inventory, and that's how you will be enough capital, and this will be giving you the cash flow benefits. So yes, option 4 is the right option. So C, it means 2, 3, and 4 is the right option. Okay. Which expense for the business may be classified as a step cost? So first one is a direct labor, direct material, factory rent, and telephone. So we know direct labor is a variable cost, direct material is also variable cost, factory rent is a fixed cost. So telephone can be step. Why? Because we have to pay maybe some service fee which is constant. But yes, if maybe we are making calls, so we have to pay some tax on each call. So it means that we have to pay some fixed cost and also the variable cost increasing with the number of calls. So it means that in the fixed cost, we know that there is variable cost, but fixed cost is included. So that's why in telephone would be the step cost. It is classified as a step cost. Okay. So now let's see the question number 21. So in the question number 21, that estimated cost of sales for the recent 2 years, year 2 and year 1 is as follows. So this is the information of average inventory, carried purchase and cost of sales for each year. Which statement regarding the efficiency of inventory turnover is correct? Okay, so if you see that I have just calculated the inventory turnover ratio for year 2 and year 1. For year 2, it is 8.5, and for year 2, it is 11.54. So this is very simple. If you want to find out the inventory turnover ratio, so what you have to do, just divide the cost of sales with the average inventory. So you will be having your answer. So year 1 is 8.5 and year 2 is 11.54. So in days, if you see that for year 1, it is 42.94 days, and for year 2, it is 31.63 days. So now let's see that whether this is showing us the efficiency of inventory turnover or not. Okay. So in the first one, that year 2 is better because the average inventory is higher. So if you see that average inventory is not showing us that this is because if you just want to find out the efficiency of inventory turnover, so you have to find out in days and in the ratio. So if it is like appropriate, so only in that case we will be saying that yes, average inventory is inventory turnover is efficient. So it means that year 2 is not relevant. It means that option A is not relevant. Option B, that year 2 is better because the inventory turnover in days is higher. So if you see that in year 2, our inventory turnover in days was 31.63. So this is not higher, this was lower. So option B is not the right option. So year 2 is worse because the cost of sale is higher. So if you see that the cost of sales in year 2 is higher than the year 1, but this is not a right year to find out that whether inventory turnover is efficient or not. So it means that C option is not relevant. Year 2 is worse because the inventory turnover in days is higher. So, but again, if you see that inventory turnover in days is not higher, this is very lower, 31.63. But if you see the definition, basically in this statement, they are asking us to just find out the right definition somewhere that can be identifying us that inventory turnover is efficient or not. So we know that if we just you can say go with the calculations. So in year 2 this is lower, and we know that if the inventory turnover days is lower, so this is kind of giving us a sign that our efficiency, we have a very high efficiency of inventory turnover. But if you see like in D option, they are saying that year 2 is worse because the inventory turnover in days is higher. But we know that if the inventory turnover days is higher, so this is basically showing us that the year 2 is worse. But if you just go with the calculation, so if you see that this is written here that this is very lower days than the year 1. So but if you just follow the definition, so D option somewhere is the right option. So that's why it means that D option can be the right option if you just go with the definition, because we know that if the turnover in days is higher, so it means that this is worse, and this is basically qualifying the characteristics of a efficient inventory turnover. Okay. Um, so just give me 1 second. Okay, so we have the question number 22, that Jim is a manager in a limited company, and he also owns a few of its shares. So why has he been looking at its most recent of financial statement? Okay. So in the option A, if you see uh, that to discover the profits made by his own department as he might receive a bonus. So this would be more specific to internal departmental reports rather than the overall financial statement of the company. So it means that option A is not the right option. So if you see the B, that he is checking his most recent financial statement. Why? Because to find out if the company made a profit, making his job more secure. So this is a valid reason, because if the company is profitable, so it suggests a business stability and there is a job security for the Jim. Option C, that to know if dividends will increase over the next 5 years, improving his income. So as a shareholder, Jim would be interested in the company's profitability and future prospects, which can influence dividend payouts. So this can be right, but let's see the D1. To see if the company has a good reputation, increasing the value of his shares. So basically, financial statements do not directly reflect the reputation. Reputation might be inferred indirectly from the consistent profitability and financial health, but it is not the primary source of such information. So, like given these points, the most comprehensive reason for Jim to look at the financial statement can be um, first of all B, because to find out if the company made a profit, making his job more secure, and can be C, that if dividend will increase over the next 5 years, improving his income. But since only one option we have to select, so in this scenario, basically B addresses both his immediate job security and the overall profitability of the company. So which directly indirectly influences dividends and share value. So therefore, we can say the best option is the B, because he just want to find out if the company made a profit, making his job more secure. Okay, so basically he is also a manager, he is concerned for his job security and also for shares. So both for both concern, option B is basically more appropriate. Okay. Okay. So we have this one. It need a lot of calculation, but we have to do it. Okay. So in the question number 19, trial balance of a company is 31st December at the end of the year one included information, following amounts. So in the ordinary share capital, we have 800,000 and share premium is 200,000 and retained earning is 1,000. On January, on 1st January in year two, the company made a right issue of 400,000 share at a premium of 0.70 per share, and this was fully taken up. So on 1st July in year two, the company issued bonus shares at the rate of new share of every four held. So this policy is to maintain reserves in most flexible form. What is the balance on the share premium account after these transactions? So this is very easy. So let's do it. I think we should do it here. Okay. So we have the additional balances. We have the additional balances in the ordinary share capital. Um, we just have to make just little statement of change in an equity. Okay, so we have first of all the balancing figure. So in the ordinary share capital, um, okay. So in the ordinary share capital, you have 800,000, which is ordinary share capital, and this would be our share premium, and this would be our retained earnings. So in the retained earnings, in the balancing figure, we have 800,000. Uh, and in the share premium, we have 200,000. And the retained earnings, we have 1,000. Okay, so when we write issue, so we have to just do a very short calculation here, a very little working. So for working right issue, what happened? So we have right issue, and we know that the number of shares issued, which is 400,000. If you see in the question again, that we right issue of 400,000 shares. So 400,000 share, its nominal value was 0.50. Right issue was 400,000 and its nominal value was 0.50, but its premium per share was 0.70. 0.70. Okay, so total nominal value, if we just multiply this 400,000 with the 0.50, so our ordinary share capital has increased by $200,000. So by nominal value, we can say that increase in the ordinary share capital, that was 400,000 multiply 0.50. So this is 200,000. And if we just multiply it with the premium, so it has increased our share premium. So 400,000 multiply 0.70. This is a premium price. So it has increased our premium by the $280,000. Okay, so when we write issue, so our ordinary share capital has increased with the $200,000 and our share premium has increased with the $280,000. Okay, so after the right issue, as you can see that ordinary share capital has increased with the 200,000 and share premium has increased with the $280,000. So what happened in 1st July in year 2? So on 1st July in year 2, what happened basically? We bonus issue. So okay, so if you see, yes, I think I should do some working here. Okay. Okay, so I'm doing the working for the bonus issue. Okay. So total shares after the right issue. So what was the total share? So if you want to find out the total shares, so initial shares was 800,000. 800,000 was the capital, but we have to find out the number of shares. So 800,000 was the capital. And if we just divide it by the 0.50, uh, 1 second, 800,000. Okay. So if you just, okay. So if it is divided with the 0.50, so you will be having the number of shares, which is 1600,000. And this is also some additional shares from the right issue. Additional shares from the right issue. And that was 400,000. If you see, that was 400,000. Okay. So 400,000 plus 1600,000. So this is equal to 2,000 shares. This is the total ordinary share capital. This is the total ordinary, not share capital, number of shares, ordinary number of shares. So if you just remember in the question, if I just take you to the question, so if you see that on 1st July year 2, the company issued bonus shares at the rate of 1 new share of for every 4 held. Okay, so it means that we have to multiply, we have to find out that how much number of shares we have introduced as a bonus issue. Okay, so just divide it with the 4, or you can also say multiply by 1 divided by 4. So it means that we our bonus issue was 500,000 shares. Okay, so bonus issue is basically, we know that it is typically done by capitalizing reserves, meaning transferring the amount from the retained earnings or share premium um, to the share capital depending upon the company's policy. But if we consider the company policy, that policy is to maintain reserves in a most flexible form. So it means that implying the company preferred not to reduce retained earning more than necessary, and may use share premium for the bonus. So if we just find out that how much, because these are the number of shares of the bonus issue, but now we have to find out that what is the value, or you can say that what was the capital of bonus issue, share capital of bonus issue. So nominal value of bonus shares, so 500,000 was a bonus issue divided by the 0.50, which was the nominal value of the our share capital. or of our ordinary shares, sorry. So this is basically the amount, which is $250,000. So this amount we have to deduct as a bonus issue. And if you see in the question again, that we have the share premium after the bonus issue, which is 200,000 plus 280,000. So what would be the total answer? So total answer for the share premium would be $480,000. Okay. So share premium after utilizing the $250,000 for the bonus issue. So 480,000 minus 250,000, because if you can see again, uh, that the share capital of bonus issue is $250,000. So because we are not receiving this amount, because this is just kind of a reward for our shareholders, we you can say that we just issued them some shares of our company without any price, or we basically just give them the share of our company, additional shares of our company as a reward. So, but this $250,000 somewhere we have to bring this $250,000 from somewhere. So how can we bring this money into the business? So basically we will be using our capital reserves. So our capital reserves would be our share payment. Sorry, our revenue reserve. So in revenue reserve, the share cap share, we will be reducing it from the share premium. So our share premium is 480,000. So just deduct the 250,000 from here. So this will be giving us the answer, which is 230,000. Okay. So it means that our yes, option A is the right option. Okay. So now let's see the other question. So yeah. So why is a statement of changes in equity prepared? So this is very, very simple. Why we prepared the statement of changes in equity. So the first option is to calculate profit when incomplete records have been kept. So we know that for it is not used for the capital. So to calculate the profit, if you want to calculate the profit, so we will be using some reverse calculation for the incomplete records, or maybe we will be making the income statement, not the statement of changes in equity. So this is not the right option. To match the dividends paid to profit for the year. Again, this is not used for this. To show the change in capital employed. So capital employed, change in capital employed. So we know that it is not only to change the to show a change in the capital employed, to show the movements in the shareholder stake in the business. Yes, because we know that we are issuing multiple shares, we are selling multiple shares in a year or maybe more than a year. So we want to basically show the movement of the shareholder stake in the business. So that's why we use the statement of changes in equity. So D option is the right option. Okay. So let's see the question number 17. So in the question number 17, a partnership provided the following information for the year. So we have the gross profit, operating cost, bank interest, interest and partners loan, interest and capital, interest and drawings. So what were the profit for the year and residual profit shared by the partners? Okay, so we have to find out the profit for the year, and after that we will find the residual profit. So this is very, very easy. So how can we find it out? First of all, write the GP. So GP is 76,000, and deduct the operating cost from it, because this is just like the expenses. So deduct 30,000 from the GP. We are basically we are making the income statement. Okay. And after that, there is a bank interest. This is also a kind of expense. So minus bank interest. This is equal to 1,300. Okay. And also minus the interest on partners loan. Because we have to pay the interest on partners loan, which means that we have taken the loan from the partner for the business, and that's why we have to pay them interest. So this would also be the expense for us. So this is 600. Okay, so after that we have the profit, which is 4 for 100. Okay, so 4 for 100 in the option A and option B. So now we have to find out the residual profit. So deduct the interest on capital from this profit. Interest on drawing, sorry. First of all, add interest on drawing. Interest on drawing. So interest on drawing was 2000 and minus the interest on capital. And this is 5600. So we have the residual profit, which is 40,500. So this is A. So it means that our option A is the right option. Okay. Uh, which provision for the Partnership Act 1819 applies when there is no partnership agreement? So when there is no partnership agreement, so it means that partner would be receiving the 5%. Yes, so partners receive 5% interest on the capital contribution. This is not written in the Partnership Act, which is 1890. So here, basically, if you don't have any partnership agreement, so C option is the right option because partners receive interest of 5% per annum on the loans of the partnership. If there is no interest, maybe you can say that ask, or you can say that required by the one partner who basically have given you the loan. So if there is no partnership agreement, so it means that that person will be receiving 5% on the loans. Okay. So after that, we are going to find out the profit for the year for the sole trader. Okay, this is easy. So let's find out. Okay, so a trader began a business on 1st January with 50,000 capital. So this is the opening capital. During the year, she introduced the business of her private vehicle, which is cost 22,000, but which was valued at 16,000. So just remember that you have to write the revaluation amount of your vehicle, not the cost. She added it to the business. Drawings for the year were $20,000 at the end of the financial year on 31st December. The closing balance on the capital account would be 105,000. So this is the closing balance, so and we have to find out the profit. So this is very simple. Basically, we have to do the reverse calculation. So what is the formula for finding out the profit? So profit is equal to closing capital plus drawings minus additional capital minus OP, the opening capital. So closing capital is 105,000 and the drawings was 20,000 minus additional capital means the vehicle, it is 16,000 and minus opening capital was 50,000. So this is all together. This is showing us the profit, which is 59,000. So C option is the right option. Okay. So now let's see the other question. So in the other question, Deepak provided the following information: allowance for irrecoverable debt was 600, and in the year 2 it is 800. Rate of allowance 3%, and year 2 it is 5%. So by how much did the total of trade receivable change from the year end of the year 2 and the end of the year 2, year 1 and year 2? Okay. So first of all, we have to find out the receivable for that. So for the year 1, so let's find it out. So for the year 1, so we know the formula that trade receivable multiply rate, which is 3% in the case of year 1. So our allowance for irrecoverable debt is equal to 600. Okay. So if you just find out the trade receivable, so just make it subject here. and this 3% would be multiplying here. So 6,600 divided by 3 multiplied with the 100. So we, because percentage is showing us the 100 amount. So this is so 600 multiplied by 100. Just give me 1 second so I can find it out. So 600 multiply 100. This is divided by 3. So this is basically 20,000 trade receivable. So now find it for the year 2. So for year 2, again, the trade receivable multiply 5% is equal to 800. So trade receivable is here, 800 multiply 100 divided by 5. So 800 multiply 100 divided by 5. This is 16,000. So the question is that by how much did the total of trade receivable change from end of the year 1 to the end of the year 2? So this is basically in the year 1 that was 20,000, and in the year 2 this is 16,000. So it means that it is decreased by the 4,000. So option A is the right option. Okay. So now let's see the other question. Okay, so this is question number 13. Okay. So a company prepared its purchase ledger control account, which showed a balance of 15,960. Okay, so we should also prepare the purchase ledger control account here. So this balance BD is 15,960. Okay. So discount received 440. 440 had been entered into the purchase ledger control account as 540. So basically, we received only 450, but we have increased the ledger by 540. So we know that whenever we are having the discount received, this could be decreasing our purchase ledger control account. But now we have to increase our purchase ledger control account. That's why, first of all, find out the difference between the 540 and 450. This is 90. So it means that we have to increase the PLCA by 90. Discount received. Okay. So in the option 3, that payment of 720 to a supplier had not been entered in his account. Okay. So we haven't entered this 720. So, but if you see that this is not related to PLCA, this is related to individual account. So it means that this option, this will not be coming in the PLCA. Purchase letter debit balance carried down totaling 1110 had been omitted from the control account. So it is omitting, and because this is the purchase letter debit balance, so it means that it should be, we know that if the debit balance in the purchase letter, so it would be written on the credit side. So this is 110. So we will be writing here, which is omitted debit balance. So we have increased the PLC. So a contra of 170 had been entered in the purchase ledger, but not in the purchase ledger control account. So we know that the contra entry always come under debit side because it is decreasing our PLC. So it means that contra entry, we have to write it here, 170. Okay, so now find it out. So 15960 plus 90 plus 1110. So this is 16,160. 16,160. So 16,160 minus 170. So we have 5,990. So C option is the right option. Okay. So let's see the other one. So what are the benefits? What are the benefits of preparing cylinder control account? Okay. So first benefit is that deducting errors of the original entry. So no, this is not the benefit of cylinder control account. Helping reduce the possibility of fraud. Yes, because sale control account and sale letter is basically prepared by the two different person. So if there is any fraud done with sale letter, so it means that it can be easily detected by the the person who is going to prepare a cylinder control account. So this is the right option. Option three, providing totals of trade receivable for inclusion in financial statement. Yes, because we had been making the seller and particular individual accounts, but at the end we need the total of the trade receivables. So that's why we will be using the seller control account just to find out the trade receivables. So it means that option 2 and 3 is the right option. So D. Okay. And in option 11, the bank statement of a business shows a credit balance of 1570. It means it's the debit balance for us at 31st December. Following differences were discovered on comparing the cash book with the bank statement. So these are the differences: unprecedented check and uncredited bankings, 1250 and 1800. A direct debit of 230 was shown as 320 in the cash book. So this is the this is basically happened in the cash book. So what is the updated cash book balance at 31st December? Okay. So first of all, our bank statement balance is 1570. Okay. 1570 is the carrot balance. Okay. So after that, there's unpresented checks. So basically, bank statement balance and the cash book balance should be equal. But yes, there is some problems, or you can say there's some errors because of that the cash book and the bank statement balance is different. So if, for example, the bank statement balance, which is 1570, is equal to the cash book balance, so we just have to rectify these errors. So unpresented check is equal to 1250. So we know that we have deducted this 1250. We basically deduct this 1250 from the cash book. That's why we have to deduct it from the, because bank manager didn't deduct this 1250 now, because your supplier hasn't you can say they represent himself in the bank. So that's why 1250 is not deducted yet. So it means that in this 1570 there is this 1250 is still involved. So that's why we have to deduct the unpresented checks from the 1570 to get the answer for the cash book. So 1250 minus plus the uncredited bankings. So uncredited bankings is basically equal to 1800. So 1800 is basically uncredited banking. It means that we added it, okay, but bank didn't. So that's why we have to add it here just to find out the cash book balance. So this is 1800. So 1570 plus, minus 1250 plus 1800. So this would be giving us the answer, which is 2120. This is the updated cash flow balance. So D option is the right option. Okay. So in question number 10, Amit compared his bank statement with his cash book. How did Amit deal with the items revealed by the comparisons? Okay. So updating his cash book. So yes, if there are maybe there are some mistake by in the writing of bank charges, so yes, he would be considering the bank charge in the updated cash flow. So this can be right. Bank charges and bank errors. So bank errors done by the bankers, not by us. So we will not be recording in this. We will not recording the bank errors in the updated cash flow. Timing differences are bank errors. So again, timing differences means that there are unpresented uncredited checks. So this is not done by, and we should not include it in the updated cash book. So that again, this is not right. Timing differences, including in the bank reconciliation statement. Okay, timing differences and bank errors. Yes, this is basically we have to rectify it in the bank reconciliation statement, because these mistakes have been by the bankers. So yes, this can be the right option. Timing differences. Yes, but B option is not right for the updated cash book. Bank charges. This is not right because this will be recording by the updated cash book. Bank charges and bank errors. So bank errors will be recorded by the bank reconciliation statement, but not the bank charges. So again, this is not the right. So it means that option A is the right option. Okay. Uh, so we have the next question, question number 9. Okay. Okay, so if you see that business prepared a bank trial balance that included a suspense account. Draft financial statement were prepared which showed a profit for the year, which is 85,000. The following errors were then discovered. So we have after correcting these errors, balance on the suspense account was eliminated. What was the revised profit for the year? Okay, so in that case, just give me 1 second. Okay, so in question number 9, a business prepared a trial balance that included a suspense account and draft financial statements. The following errors were then discovered. So first of all, discount allowed of 1,000 had been debited to the discount received account. So if you see that discount allowed is 1,000 and it is debited in the discount received account, it means that you have decreased the discount received account. Okay, but you didn't record the discount allowed account. So it means that now you have to decrease increase the discount received account by the 2,000, and also you have to increase the discount allowed, which is 1,000. So this its net effect would be 0. So it means that this would not be affecting the profit. Motor expenses of 4,000 had been debited to the purchases account. Again, because we know the purchase account, if the purchase account is increasing, if it is going to rectify this error. So if the purchase account is increasing, so it means that it would be increasing your cost of sales and decreasing GP, and hence decreasing your profit. So if the motor expense is $4,000, so again it's decreasing your profit. So it means that if we rectify this error, so it's again the net effect would be 0. Payment for purchases of 5,000 had been correctly entered in the cash book, but credit to the drawing account. Okay, so it should be uh, credit. Your cash book should be credit, and your purchases should be debit. So if the purchase is debit, so it means that it would be increasing the cost of sales. Okay, and decreasing the GP with the 5,000, and hence your profit is also decreasing with the 5,000. So it means that 85,000 minus 5,000 is equal to 80,000. So C option is the right option. Okay. So the next question. Mm, okay. So in number 8 error. Okay. So in the 8 question, which error will cause the trial balance not to balance? An invoice entered as a credit note on an original amount. Okay. So which error will cause a trial balance not to balance? Okay. Okay. So in for the first one, if you see that for the first one, that invoice entered as a credit note on the original output. So what happened here? So this type of error will affect the classification of transactions. It means sales instead of purchases or vice versa. So, but it will not necessarily cause a trial balance to be unbalanced, as the total debits and credits might still match. So it means that this is not the option. So if we talk about the B, so in the B, a journal entry that does not balance. So journal entry that does not balance means that the total debit do not equal the total credits. So this directly causes the trial balance to be out of balance. So this can be right. But let's see the C part, C option. A transaction entered as a wrong amount on the original output. So if maybe both the debit and credit sides of the transaction are recorded with the same wrong amount, so trial balance will still balance. But however, if only one side is entered incorrectly, so this will cause a trial balance not to balance. So this is not the right option. D, a transaction not entered in the books of accounts. So it means that if a transaction is completely omitted, both the debit and credit sides are missing. So the trial balance will still balance. However, it will result in incomplete accounting record, but still this is the balance. So it means that option B is the right option. Okay. So let's see the other question. Question number 7. That a company purchased machine on 1st April 2021 for 25,000. It was depreciated at 20% per annum using straight and method. A full year depreciation is charged in the year of purchase but none in the year of sale. On 30th June 2023, machine sold for 12,500. The company's year ended on 31st December. So what was the profit or loss on the disposal of the machine? Okay. So first of all, let's find out its depreciation. So $25,000 was the cost, and okay. So multiply it with the 20% because it's a depreciation rate, and multiply with the 2. Why? Because there's only 2 years depreciation charge. It is purchased in 2021. So the depreciation policy is saying that you should not charge a depreciation in the year of purchase. So it means that, and you just sold out the size in 2023. So it means that 2022 and 2023. So for these years, depreciation would be charging. So it means that your total depreciation would be 10,000 for the 2 years. Okay, and now if you want to find out its net book value, so cost minus AD. So cost is equal to 25,000 minus AD is equal to 10,000. So it means that your net book value is equal to 15,000. But if you see that your machine is only sold for 12,500, but its net book value was 15,000. So it means that 2,500 is a loss on disposal. So C part is the right. C part is the right answer. 2,500 loss. Okay. So in question number 6. At the beginning of the financial year, on 1st January, a business acquired a new motor vehicle for 34,000. In the error, this was recorded in the account of motor expenses. Okay, so we basically increased the expenses by $34,000. Motor vehicles are depreciated using the reducing balance method at the rate of 30% per annum. It is estimated that motor vehicle will residual value of 4,000 at the end of its life. If error is not corrected, what will be the effect on the profit for the year ended 31st December? Okay. So here basically if you see that 34,000 was the cost and its depreciation was 30%. So this is giving us a depreciated amount which is 10,200. So this is depreciated by 10,200. So you have recorded this $34,000 as an expense, but you also recorded a depreciation which is 10,000 to 1,200, 200. So it means that your expenses has increased by 34,000 and decreased by 10,000 to 200. So it means that net effect would be the difference of these digits. So 34,000 you have decreased the profit by 34,000, and again you have increased it, decreased it by 10,200. So it means that your profit would be understated by 23,800. Understated. So it means that B option is the right option. Okay. So now let's see the question number 5. What are the characteristics of a non-current assets? Okay. They are not intended for resale. Yes, we basically use it for making revenue. Not we have no intention to resell it. They provide the future economic benefits. So yes, this is also right. They prevent the company from going out of business. No, this is not right. So 1 and 2 only. So A option is the right option. Okay. So Tom bought goods costing 100 on credit from Sam. He did goods costing 20 as faulty. He deducted a cash discount by 70 and paid $76 by check in full settlement. Which amount were recorded in the Tom's book of the prime entry? So this is very easy. He purchased the goods for 100, so it means that he would be recording $100 in the purchase journal. And after that, he returned the purchases, which costed $20. So it means that you will be recording $20 in the purchase return journal. And he paid $76. So it means that he will be recording this $76 three-column cash book. So it means that C can be the right option. Okay, so in question number 3, which item will not be debited to account in the purchase ledger? Okay, so discount allowed. So we know which item will be debited to. Okay, so this would not basically recording in the purchase ledger. This is not the right option. So payments to supplier, yes, this will be recorded on the will be debit. Yes, this will be recorded on the debit account, debit side on the purchase ledger account. And in the option 3, purchases. So we will not be recording purchase in the debit side. We will be recording it on the credit side. So purchase return, yes, this will be recording on the debit side. So it means that 2 and 4, D option is the right option. Question number 2. Which source of finance would be available to a public limited company but not to the partnership? Okay. Bank overdraft. So yes, this will be available for both. Debentures. Yes, this is only available for the public limited company. Leasing. This is also available for both. Credit card. This is also available for both. So it means only debentures would be available to public limited company but not the partnership. Whether statement about a sole trader is correct. They always trade by buying and selling goods. No, they also can be involved in the manufacturing sector. They do not employ any staff. Yes, they do, but very lesser staff. They keep all their profit themselves. Yes, they maintain a retained earning account. No, this is only made by the PLC. So C option is the right option. Okay. So finally, we have done with the all MCQs. So let's meet in the other video.